This video is for general educational purposes only and should not be considered financial advice. Always do your own research before making investment decisions. Gold has been trusted as a store of wealth for thousands of years. Empires have risen and fallen. Currencies have been created, weakened, and replaced. Yet gold continues to be owned by governments, central banks, institutions, and individual investors around the world. Many people see gold bars worth thousands of dollars and assume that investing in physical gold is outside their reach. But gold can be purchased in much smaller quantities, including 1 gram and 5 gram bars. It can also be traded through exchange-traded funds, mining shares, futures, and options. So what makes gold valuable? Why does its price rise and fall? How do interest rates affect it? And what are the different ways an ordinary investor can gain exposure to gold? In this video, we'll explain how gold works, how it is used, how it is traded, and the risks and costs you should understand before investing. Gold is valuable partly because it is scarce. Unlike paper currency, it cannot simply be created by a government or central bank. New gold must be discovered, mined, processed, and refined. Developing a new gold mine can require years of exploration, planning, approvals, and construction. Gold is also durable. It does not rust or corrode easily, which means gold recovered hundreds or even thousands of years ago can still exist today. It is relatively easy to divide into smaller quantities, and its appearance and physical properties make it widely recognizable. Gold is also accepted internationally. A gold bar is not dependent on the success of one individual company, government, or currency. This has allowed gold to remain a recognized store of wealth across different countries and generations. However, gold's scarcity does not mean the supply can never increase. Most gold mines are developed primarily to produce gold. If the gold price remains high enough, mining companies may expand existing mines or invest in developing new ones. This can gradually increase the amount of gold available. However, bringing new production onto the market is usually slow and expensive. Gold's value therefore comes from a combination of scarcity, durability, global recognition, and the long history of people trusting it as a store of wealth. That does not mean its price always rises. Gold can fall in value and can remain flat for long periods, but these characteristics help explain why it continues to play an important role in the global financial system. To understand why gold is still important today, it helps to understand the role it once played in the world's financial system. For much of modern history, many countries operated under what was known as the gold standard. Under the gold standard, paper money represented a claim on a fixed amount of gold held by the government. In simple terms, if you held paper currency, you could exchange it for a specified amount of gold. Because of this, governments couldn't simply print unlimited amounts of money. They needed sufficient gold reserves to support the currency they had issued. For thousands of years, a nation's wealth was often measured by the amount of gold it controlled. Even today, central banks continue to hold thousands of tons of gold as part of their national reserves. Over time, however, the world changed. International trade increased, economies expanded, and governments found the gold standard increasingly restrictive. In 1971, the United States ended the direct convertibility of the US dollar into gold. This marked the end of the Bretton Woods monetary system and effectively ended the gold standard for the world's major currencies. From that point onwards, most countries began using what are known as fiat currencies. The word fiat comes from Latin and means let it be done, or by decree. A fiat currency has value because a government declares it to be legal tender, and people have confidence that others will continue to accept it in exchange for goods and services. Unlike the gold standard, today's currencies are not backed by a physical commodity. Instead, they are supported by confidence in governments, central banks, and the strength of the economy. Some investors see this as one of the reasons to own gold. Governments can create more currency if necessary, but they cannot simply create more gold. That doesn't mean gold is always a better investment than shares, property, or bonds, but it helps explain why gold has remained an important asset throughout history and why central banks still hold significant amounts today. Gold is purchased by a wide range of people and organizations, but not all of them buy it for the same reason. The largest source of demand globally is jewelry. In many countries, particularly India and China, gold jewelry is purchased not only for its appearance, but also as a long-term store of wealth that can be passed from one generation to the next. Central banks are another major buyer. Many governments hold gold as part of their national reserves to diversify away from relying solely on foreign currencies. Investment funds and individual investors also purchase gold. Some use it to diversify their portfolios. Others buy gold during periods of economic uncertainty, geopolitical tensions, or concerns about inflation. Gold also has important industrial uses. It is an excellent conductor of electricity and is highly resistant to corrosion. Because of these properties, gold is used in electronics, aerospace technology, specialized medical equipment, and other high reliability applications. However, industrial demand represents a much smaller proportion of total gold demand than it does for silver. Gold is primarily influenced by investment demand and central bank buying. Silver is influenced by both investment demand and industrial demand. Understanding who buys gold helps explain why its price can move for many different reasons. Changes in jewelry demand, central bank purchases, investor sentiment, and industrial activity can all influence the market. Gold and silver are often grouped together as precious metals. They frequently move in the same general direction. However, they are very different investments. Gold is primarily a monetary metal. Its price is heavily influenced by investor confidence, central bank buying, economic uncertainty, and global financial conditions. Silver is both a precious metal and an industrial metal. It is widely used in solar panels, electronics, batteries, electrical equipment, and many manufacturing processes. As industrial activity increases or decreases, demand for silver can change significantly. Another important difference is how the two metals are produced. Most gold mines exist primarily to produce gold. If the gold price remains high for long enough, mining companies may invest in expanding production or developing new mines. Silver is different. A large proportion of the world's silver is produced as a byproduct of mining for copper, lead, and zinc. In many cases, mining companies are producing copper and the silver is recovered during the refining process. This means that increasing silver production is not always as simple as opening a new silver mine. Supply often depends on demand for other industrial metals. This difference in supply helps explain why silver can sometimes experience much larger price swings than gold. Neither metal is automatically better than the other. They simply respond to different forces within the global economy. If you'd like to learn more about silver investing, we've produced a separate video dedicated entirely to silver, including the different ways investors can gain exposure and the factors that influence its price. People buy gold for many different reasons. Some investors see gold as a way to diversify their portfolio. Others buy it during periods of economic uncertainty, when confidence in other investments may be falling. Some investors believe gold can help preserve purchasing power over the long term. Unlike shares, gold doesn't represent ownership in a company. Unlike bonds, it doesn't pay interest. Unlike property, it doesn't generate rental income. Instead, investors hope that gold will retain its value over long periods, particularly during times when other assets are under pressure. This is why gold is often described as a store of wealth rather than an income-producing investment. That doesn't mean gold always performs well during difficult economic periods. Like every investment, its price is determined by supply and demand. Because gold has been trusted for thousands of years, many investors choose to hold at least a small allocation as part of a diversified portfolio. One of the biggest influences on the gold price is interest rates. Gold does not pay interest or dividends. Imagine you have two investment choices. You can place your money into an investment paying a guaranteed rate of interest, or you can buy gold, which produces no income at all. When interest rates rise, income-producing investments often become more attractive. As a result, some investors reduce their exposure to gold. When interest rates fall, the opportunity cost of holding gold becomes lower. This can make gold more attractive to investors. However, interest rates are only one factor. Inflation, currency movements, geopolitical events, economic uncertainty, and central bank buying can all influence the gold price. We'll explain how interest rates affect investments in much more detail in a dedicated video because they influence almost every major asset class. There are several different ways to invest in gold. Each has its own advantages, disadvantages, and level of risk. The most traditional approach is buying physical gold. This usually means investment-grade bullion in the form of bars or government-issued coins. Many people believe physical gold is only for wealthy investors because they often see 1-ounce gold bars worth several $1,000s. Fortunately, that isn't true. Many bullion dealers sell much smaller bars, including 1 gram, 2 gram, and 5 gram sizes. These smaller products make physical gold accessible to investors with much smaller budgets. However, there is an important trade-off. The smaller the bar, the higher the premium you will usually pay above the spot price. Before we explain why, it's important to understand another term you'll often hear. The spot price is simply the current market price of gold. Think of it like the share price of a listed company. Just as a share price changes throughout the trading day as buyers and sellers trade, the spot price of gold also changes continuously while global markets are open. If you buy a physical gold bar, you won't normally pay the spot price. You'll usually pay more. That extra amount is known as the premium. The premium helps cover refining, manufacturing, packaging, transport, insurance, and the bullion dealer's costs. Because these costs don't reduce very much on smaller bars, a 1 gram bar can cost significantly more per gram than buying a larger 1-ounce bar. Many experienced investors therefore save until they can buy larger bars or coins, reducing the premium they pay. When you eventually sell your gold, the opposite usually happens. The bullion dealer is buying an existing investment product rather than supplying a newly manufactured one. As a result, the amount deducted below the spot price is often smaller than the premium you originally paid when buying. This means you'll normally buy above the spot price and sell below the spot price. The difference between those prices is known as the spread. Like brokerage fees when buying shares, the spread is one of the costs of investing and should always be considered before making a purchase. For this reason, physical gold is generally better suited to long-term investors than people looking to trade frequently. Another popular option is a gold exchange traded fund, often called a gold ETF. Instead of storing gold yourself, the ETF provider stores the bullion on behalf of investors. You simply buy and sell units in the fund through the share market, making gold ETFs one of the simplest and most cost-effective ways to gain exposure to the gold price. More experienced investors may also invest through gold mining companies, futures contracts, or options. We'll briefly cover mining companies next. Another way to invest in gold is by buying shares in gold mining companies. Although these companies produce gold, buying their shares is very different from owning physical gold or a gold exchange traded fund. When you buy a gold mining company, you're buying part of a business. Its success depends on much more than the price of gold. Mining companies must control their production costs, manage debt, replace the gold they mine through exploration, comply with environmental regulations, and operate safely. They can also be affected by labor shortages, rising fuel prices, political instability, and changes in mining laws. A rising gold price can increase a mining company's profits. However, if the company is poorly managed or its costs rise too quickly, its share price may still fall. Likewise, a well-managed mining company can sometimes outperform the price of gold. Mining shares, therefore, have the potential to generate higher returns than gold itself, but they also carry additional business risks. Before investing, it's important to understand whether you're buying the metal or buying a company that produces it. Gold has played an important role in the global financial system for thousands of years. It has survived the rise and fall of empires, currencies, and economic systems. Today, investors continue to buy gold for many different reasons. Some see it as a store of wealth. Others use it to diversify their portfolio or help manage risk during periods of uncertainty. Gold can be purchased in many different ways, including physical bullion, gold exchange traded funds, and mining companies. Understanding concepts such as the spot price, premiums, and spreads can help you make better investment decisions and avoid unnecessary costs. Like every investment, gold has both advantages and disadvantages. The key isn't deciding whether gold is a good or bad investment. The key is understanding why you own it and how it fits within your overall investment strategy. Whether you decide to invest in gold or not, understanding how it works will make you a better informed investor. If you found this video helpful, please consider subscribing to Practical Assets. Subscribing is completely free, it costs you nothing, and it really helps the channel grow. If you'd like to continue learning, watch our Silver Investing Explained video next. Thanks for watching, and I'll see you in the next video.